Welcome back, everyone. Thank you so much for tuning in. Another record day for Tesla's stock. And by my calculations, short sellers lost $3.225 billion today. And another fascinating thing, if you've watched my earlier videos, you know that I've developed a theory that there are some extremely large institutions accumulating Tesla stock, and 46 million shares traded today, which is huge volume for the stock, which typically sees 11 to 12 million shares of average daily volume. And I think this is significant because when we get a price movement like this, you want to look and see, hey, how much activity is there around this move? And today there was a lot. So it's absolutely crazy. There's so many things to talk about today. My last short squeeze video got about over 32,000 views. I need to change my channel name. So if you have a recommendation, please leave me a note in the comments below. And on one of my next videos, if I select your name, I will promote whatever you want. It could be your name, your screen name, your dog's name, anything you want. Leave me a recommendation if you have an idea on what I can change my channel name to. Thank you. I also want to give you guys an update in terms of what's going on with the media. Is the tide shifting? And I selected some of the most outrageous questions from the fourth quarter call that I don't really think people have been playing, and I don't think that these questions have gotten a lot of airtime, but Wall Street is still basically framing things for Tesla in a way that's asking, hey, are you guys going to go bankrupt soon? Or are you guys in financial trouble? You know, what's the deal? And so I really want to look at whether or not the tide is finally shifting in terms of how the media looks at Tesla versus the reality of Tesla. What are the perceptions? What is the reality? And I pulled an amazing clip of Steve Jobs addressing the early Apple short sellers, and I think you're going to find the parallels with Tesla today incredible. So stay tuned for that. I also have a mind-blowing, and I'm sorry to be so hyperbolic, but this is the only way to describe it, a mind-blowing trade where somebody on Twitter took the other side of a position from Mark Spiegel, who we've covered. Mark Spiegel is a short seller, a Tesla short seller. There was somebody who posted a trade on Twitter where they basically bought call options from Mark Spiegel in 2018, and they're up over $200,000. In fact, they were up $200,000 when they posted this trade. I think they could be up another $200,000 for $400,000 total. So we'll get to that. I'm going to give you an update on David Einhorn, another Tesla short seller. And first, let's take a look at Michael Novogratz and his trading on Tesla. I really respect Michael Novogratz, and if you haven't read about his history with Bitcoin and Ethereum, I will leave a link to an incredible article in the description below. I really think you should check it out. Maybe I'll do a video on it one day, but anyway, here's Michael Novogratz.
Tesla. You were short Tesla going into yesterday's earnings report. What were you thinking?
You know, I had a great start to the year. The chart looks parabolic. I mean, I cut against my own rules when I said, you know, don't short Elon Musk, and Tesla feels like Bitcoin, right? It's not even it's not a fundamental story anymore. And so any bit of good news was going to shoot it up. I'll give it a couple days, and I'll probably be able to get out of my shirt without that much pain, but it was not a great morning.
You think it's going to back off $650?
It should back off some at one point. Like, things just don't go to the moon. But
so there's Michael Novogratz with a trading update, and I do agree with him that you shouldn't bet against Elon Musk. I'm not sure if I agree with his trading, but that's okay. And then here's another fascinating thing. So we know, we've talked about it in the past, the billions of dollars that Ford and GM and others spend on advertising. There were some electric vehicle advertisements which premiered at the Super Bowl this past weekend, and here's what Tesla got for free.
This is the most Teslas that I've seen on one team that I've been to.
I know a couple guys on the team have a Tesla, and just the technology that's in there is pretty amazing.
Tesla is like an airplane on wheels. Like, it's fast. Like, it's 0 to 60 in literally 2 seconds.
I've been in a Tesla before, and it was driving itself, and I did not like it.
The Tesla looks nice. I ain't gonna even lie to you. I seen one of them park itself in our parking lot, and I was like, oh my. This is what it's like now.
It drives 95% of my drive to work every day.
Anyway, we've talked a lot on this channel about how it doesn't make sense necessarily to follow the Wall Street consensus. And the reason is you will be behind the curve in a lot of cases. Here's an example of a Wall Street analyst that today, Argus Research, took their price target on Tesla up to $808 from $556. And if you had waited until today to follow what they were doing, you basically would have missed a huge amount of the stock price increase. So you have to be careful with that. I wanted to talk a little bit about David Einhorn, who's notable for his short position in Tesla and the back and forth that he had with Elon in 2019.
Musk tweeting a letter to Einhorn saying that his latest quarterly letter was ripe with quote, false allegations against Tesla. Musk said Einhorn was only making those to save face with his investors after Tesla's successful third quarter. Einhorn fired back, noting that they both struggled last year, but that a big difference was that his firm, Greenlight, had generated real profits for their investors since they began in 96.
So here's what's interesting. There was an article in 2018 stating that Greenlight Capital, David Einhorn's fund, had compounded at approximately 15% since 1996. Now, I don't think they had a great 2018. Let's just say he compounded at that same level, 15%. Well, if you bought Tesla shares at the IPO, I'm assuming you bought them at the end of 2009, even though they IPO'd in June of 2010. So even a little bit more conservative. If you closed out your position today, you compounded at an annual rate of 42%. So your investment in Tesla would have compounded a little bit better than an investment in Greenlight. And so Greenlight apparently is down 7.6% in the first month of the year. Somebody on Reddit had a hilarious comment about Greenlight. And again, all due respect to all market participants, including all the short sellers and everybody else. Short sellers, no big deal. But anyway, somebody on Reddit pointed out, hey, so this guy is short Tesla and long GM. It's like an SNL skit. And I just want to take a brief moment to discuss value investing for a second, because that's a very popular phrase. And I know people trace sort of the origins back to Ben Graham and Warren Buffett and all those famous investors. And the point about value investing is I think sometimes people get it conflated with value investing means you buy a cheap stock. Well, a stock that's inexpensive based on today's earnings doesn't necessarily mean it will be a good value in the future, because you want to buy a stock that will be a good value once it reaches its full earnings potential in the future. And so the question is what are you paying for versus what are you getting? And whereas GM might be a very cheap stock based on present earnings, Tesla also may be a very cheap stock based on future earnings. And that's the basic point. Here's that Steve Jobs clip I was telling you about, and I think you're going to find the parallels with Tesla and what's going on today pretty amazing. So take a listen.
Steve, what do we do about the press? I mean, the Wall Street Journal reporters get up in the morning, sell Apple short, and then go write stories about us. And it's clear that it's a perception versus reality problem.
Yeah.
They don't know shit about operating systems. They don't know anything about tools. They don't know what's going on in the future.
Sure. You know, I'm sure that a lot of you have had this experience where you're changing, you're growing as a person, and people tend to treat you like you were 18 months ago. And it's really frustrating sometimes when you're growing up and you're becoming more capable and you've solved, maybe you had some personality quirks you've kind of gotten over, whatever it may be, and people still treat you like you were a year to 18 months ago. It can be very frustrating. Well, it's the same with a company. It's the same with the press. The press is going to have a lag time. And the best thing that we can do about the press is to embrace them, do the best we can to educate them about the strategy, but to keep our eye on the prize, and that is turning out some great products, communicating directly with our customers as best we can, getting the community of people that are going to make this stuff successful like yourselves in the loop so you know everything, and just marching forward.
So that's pretty amazing. And you can tell that Elon is definitely reading out of the same book that Steve Jobs was, by focusing on the products, by getting the truth out there, and just by delivering a great customer experience. Never mind the press and never mind the shorts. Back in 2018, Warren Buffett and Elon were trading words, and the media tried to stoke the fire a little bit.
Do you even know Elon Musk?
I've never said anything negative about Elon. I mean, you're baiting me a little bit to do it. But,
I am.
But I've never, people like his car and everything, but.
So lots of people get their news and their information through traditional media sources, and oftentimes those sources are correct. But the point is you have to think for yourself. You have to go to the primary source. I think people who have done a really good job at understanding the Tesla story and really hearing and being able to understand Elon's vision, those people have benefited greatly versus others that have just read headlines. And I'm not suggesting that Warren Buffett does that, but it is just interesting to see that type of thing happen. Now, here's the story I wanted to tell you about Mark Spiegel, and it's absolutely incredible. So the Third Row podcast tweeted out this little excerpt from a trading update that he sent about his performance in January. And Spiegel discusses taking a hit on these January 2021 calls that he had shorted back in 2018. And so he talks about how coming into January, I guess the calls had increased in value so much that they represented just under 5% of his fund when they were priced at 14. And when the stock rocketed in January, he stopped them out, basically covered or bought them back at $25 to $35. So basically $15 higher than they were. And they finished the month, January, at 108. They're over 200 now. So we kind of had this open-ended short position where he had sold calls on Tesla. And anyway, here's the crazy thing. We had this person on Twitter today saying, hey, I think I bought those calls from Mark Spiegel, the ones that he sold. And this person spent $2,000, $2,300, you can see here, on the Tesla January 2021 690 calls. And their unrealized P&L was $212,000. This is before the calls increased today. And the last time I checked, the price of these calls, which were 109 when he posted, are now 207 if everything is right. So that means that his profit almost doubled from this level. So he could be up over $400,000, which is absolutely crazy. And then somebody posted this chart of the price history of that call. And we talked a little bit about the trading styles of three different investors. So we have Mike Novogratz, who's a little bit more of a technician, sort of a macro investor, and he does lots of different things like Bitcoin and currencies and all these different things that he had sort of shorted Tesla as a trade, not really as somebody who wanted to bet against Elon Musk. And we can debate about the merits of doing something like that. But, you know, he shorted it for a short-term trade. He was wrong. He's going to get out. Then we have David Einhorn, the value investor who's long the cheap stock in GM and short the expensive stock in Tesla. And that's another sort of style. And then we have Mark Spiegel. And this is just very interesting from a risk management perspective, because what David Einhorn did was he purchased puts. So as the price of the stock goes up, the price of the puts go down and the position in your fund gets smaller, and thus the risk is lower. Mark Spiegel did the opposite. So he sold calls where as the price of the stock increased and the trade went against him, the position in his portfolio actually increased and got bigger. So the risk was increasing as he was becoming more and more wrong, which is a little crazy. And so this person points out that, hey, if he had sold the calls here in 2018 around $17 or $18, that he had a chance to cover those calls with basically 94% of the maximum potential profit all through this summer. And the fact that he let those options stay outstanding, which then went on to lose him a tremendous amount of money, is a little bit, you know, from a risk management perspective, I'm not sure. It's sort of an interesting trading style. And maybe he didn't do this, you know, I'm speculating, but I'm just taking what he wrote in his letter according to Third Row and taking a look at the trading history of those options, and very interesting. So two more things very quickly. I wanted to play those outrageous questions that Tesla got on the Q4 call, which just showed me that at least going into the fourth quarter, the broader analyst community on Wall Street was still not ready to believe Tesla, not ready to believe in the cash flow potential of Tesla, not ready to believe in the profitability and the growth and all of those things. And before we get to that, I just do want to give a shout out to Wedbush and Dan Ives. And interestingly, his bull case for Tesla at $900 are based on earnings numbers which kind of approximate the ones that I was guesstimating for 2021, which are EPS figures of $19 to $20 a share. I think his numbers are a few years more pushed out than mine, and I could be aggressive, but this is really interesting about Dan Ives.
Why? What did we learn about this quarter? Revenue beat, earnings beat. What are we hearing in terms of the outlook for deliveries as well?
It's profitability. Because look, as we've discussed with you and the team many times, profitability is the key. If they could do this profitably with this type of demand, that really is the 1-2 punch to get the $15, $20 earnings power.
So really interesting updated commentary from Wall Street. Also, if you haven't already, please subscribe to this channel. It really makes such a huge difference to increase the quality of these videos. And I release a video every single weekday, so I really hope you're enjoying them. Thank you for subscribing. And here, in my opinion, are the most outrageous moments from the Q4 call. I don't think these are getting a lot of airtime, so have a listen.
Okay, the next question from institutional investors is, given the recent run in the share price, why not raise capital now and substantially accelerate the growth in production, i.e. build the gigafactories, investment in supercharger and customer service?
Well, we're actually spending money as quickly as we can spend it sensibly. So if there's any sensible way to spend money, we are spending it. There's no artificial holdback on expenditures. But I mean, that's I'm sort of, I'd say, relatively obtuse. It's not, I'm not thinking about it very much, to be honest.
Hi, good evening. Thank you for taking the questions. Just want to follow up on the question on capital raise. So given the cheaper cost of capital, and this is a real competitive advantage for others, why wouldn't it make sense to raise capital to either pay down debt or to pursue acquisitions, especially bolt-ons that could help you accelerate capabilities in autonomous or battery technology?
I mean, if you know of any acquisitions, we'd love to hear about them. Yeah, sure. Sounds great. Who should we acquire?
Well, given the importance of autonomous, I imagine that this is an area that you would want to accelerate if you view it as a crucial competitive advantage.
We're not aware of any one that we'd want to acquire.
And debt pay down?
Diluting the company to pay down debt doesn't sound like a wise move.